I am acutely conscious that after Axel asks me questions is the cocktail, so I better bring my A game here. Listen, I really wanted to come to this. It's a pleasure to be at the IIF. It's a pleasure to be in Japan for the G20 because you are addressing some of the most important issues in your day-to-day businesses, but as part of this institution, most important issues in the global economy, and the Japanese presidency has put some of those most important issues at the heart of the G20, and I commend Kuroda-san, Minister Aso, and indeed the Prime Minister for doing so. What I want to talk about today is your raison d'etre, which is cross-border capital flows. Now, I think this room would agree that capital flows can be an enormous force for good, and I'll use the example of my native Canada when it was an emerging economy. Imported 10% of GDP of capital year in, year out for 3 decades. But the more recent history is somewhat more checkered. In fact, this institution, this group, the IIF, was founded 36 years ago in response to the Latin American debt crisis, a crisis that reminded us that while capital flows can support growth, capital flow volatility can undermine it. And subsequent crises in Asia 15 years later, again in Latin America around the turn of the millennium, and indeed in advanced economies themselves, reinforce the risks of taking capital flows for granted. In theory, capital flows support growth through greater allocative efficiency, better risk sharing, and increased technology transfer. But in reality, they have proved a double-edged sword. Time and again, we've seen big waves of inward investment into emerging economies that are then sharply withdrawn. And more generally, financial openness has tended to amplify domestic imbalances and leave EMEs more vulnerable to foreign shocks. As a consequence, 1/5 of all surges of capital into EMEs have ended in financial crises. And EMEs are at least 3 times more likely to experience a crisis after capital flow surges than in normal times. Given this track record, EMEs have defensively accumulated reserves and limited the opening of their capital accounts. And overall, they've increased their financial openness by considerably less than advanced economies. And this is understandable, but these responses carry significant opportunity costs. Excess precautionary savings in EMEs are pushing down global equilibrium interest rates, increasing the risks of a global liquidity trap. And enormous cross-border flows will be required to close the infrastructure investment gaps in emerging economies and to finance the essential transition to a low-carbon economy across the globe. So what I propose to do now is to examine what drives capital flow volatility and start to sketch an agenda for sustainable capital flows in a new world order. Specifically, what should the priorities be for emerging economies, for advanced economies, and what is the impact of the international monetary and financial system itself, and therefore what are reform priorities for them? And in order to answer these questions, I'm not just going to stand up and, as I usually do, and assert. I'm actually drawing on some research which is detailed in the formal version of this speech, and then a subsequent research paper that's coming out from the Bank of England, which looks to start to develop a holistic, so a comprehensive framework to look at the 3 drivers of capital flows at risk. And we've labeled them pull factors, so domestic conditions in the institutions, so think in the emerging economies, that affect the relative attractiveness of investing there. The push factors, which include global risk appetite and financial conditions, particularly dictated by the level and prospects for U.S. monetary policy and financial conditions. And then, just to keep the alliteration, the pipes. The structure of the global financial system itself. And the reason we're having this before the cocktail party as opposed to after is because of the next diagram. which I'm going to use to kind of dimension these factors. And so just give me a second to explain. It won't be difficult actually in this room, but the gray line in the chart basically shows the unconditional distribution of capital flows to emerging economies between 1996 and 2018. So this is across a panel of emerging economies. And the purple line shows how it would shift in response to a negative shock. So basically the capital flow at risk, the 5% threshold there as a percentage of GDP goes up. The left tail is fattening. Now, I'm going to use this to bring together the three elements and draw some of those tentative conclusions. But just to give you the punchline, one of the core findings is that all three of the drivers matter: the push, the pull, the pipes. And that means we all have a role, advanced economies as well as emerging economies, and the private sector as well as the public sector, in taking steps to build and increase the degree of sustainable capital flows. So let me turn to some more detail. And I'll start on the pull factors, so the factors in the emerging economies, because that has been the conventional wisdom for decades. Conventional wisdom, the best contribution that countries can make for themselves and for others is to, quote, keep your own house in order. Some of you in the audience may have heard that from the G7 and others. And that foundations of that house, all sound advice, foundations of that house, credible inflation targeting regimes with an operationally independent central bank, flexible exchange rates to act as a shock absorber, fiscal sustainability to give governments room to respond to adverse shocks, something newer, an effective macroprudential toolkit, and deep domestic capital markets. And our analysis finds that these conventional prescriptions to concentrate on putting one's house in order has merits. Pull factors were the main cause of capital flow volatility in the run-up to the crisis. And then over the years, as the economies took that medicine, if you will, or acted on that prescription, adopted inflation targeting, generally improved fiscal positions, increasingly used macroprudential policy, you see the sharp reduction in capital flow at risk because of actions on total by emerging economies. And of course, there are a few exceptions in the course of the last couple of years one can think of, but it's almost that those exceptions, if you look at the causes of their situations, prove the rule. Now, there's one caveat to this, that one area where there's been less progress has been the growth in FX-denominated debt, which has doubled since the turn of the millennium. And as well, even though there has been deepening of domestic capital markets, the share of foreign ownership of those markets has increased from about 5% to 25% today. But on net, the core conclusion remains that the improvements in domestic institutional pull factors have substantially increased the sustainability of capital flows to emerging economies, shifted the distribution to the right, if you're still with me. Unfortunately, and that's a conclusion that is all else equal, the classic phrase of an economist, and of course, all else is never equal. And what has changed? Well, one of the big things that has changed materially has been the push factors. That has steadily increased over time as monetary policy and financial stability shocks from advanced economies have become both more prevalent and more potent. And these push factors are arguably becoming more important as the fundamental asymmetry at the heart of the global economy deepens. When the IIF was founded 36 years ago, as I said, emerging economies made up a little more than a third of global GDP. In the last Fed tightening cycle, their share of global activity had risen to about 45%. In this Fed tightening cycle, the most recent one, it was 60%. And by 2030, it's projected to rise to around 3/4. But while the real economy, the real global economy, is being reordered, the international monetary and financial system has barely begun its transition. The dollar represents the currency of choice for at least half of international trade invoices, 2/3 of global securities issuance. It denominates 2/3 of foreign exchange reserves and external debt, and it acts as the monetary anchor for countries representing 70% of global GDP. In other words, the dollar is as dominant today as it was at the end of the Bretton Woods era, and it's likely to remain so for some time. And this means that the U.S. has disproportionate influence on global economic and financial conditions. And indeed, our research suggests that the influence of U.S. financial conditions on foreign GDP has increased by 1/3 since the 1990s, despite the U.S.'s declining share of global GDP. So, consequence of that is that when the Fed responds, rightly so, when it responds to domestic developments in the U.S., such as a loosening of fiscal policy, global financial conditions and activity react strongly. This was the case in the taper tantrum of 2013. It was the case over the past year as Fed communications significantly shifted expectations for U.S. monetary policy, and in both periods you see a sharp shift in capital flows at risk in emerging economies. It's also the case, and you can see on the chart, that financial instability in advanced economies has influenced the sustainability of capital flows to EMEs. So think of the banks having to tighten in 2008-9, both because of capital and liquidity reasons, sharp outflow. Augustine painfully lived through that. There was an innocent bystander right there. Similar dynamics, not quite the same amplitude, but similar dynamics around the euro crisis in 2011. So in sum, what we find is that in total, push factors from advanced economies have offset much of the improvements of these pull factors from emerging economies. Keeping one's own house in order is necessary but not sufficient for sustainable capital flows. And this underscores the importance of the third driver, which is what we're calling the pipes, or the structure of the global financial system itself. And since the 2008 crisis, the pipes themselves have changed in three ways. The first is positive. The financial reform effort of G20 financial reform effort has made the core of the system safer, simpler, and fairer, and that has reduced capital flows at risk. Secondly, the growth in asset management from around $50 trillion a decade ago to $80 trillion today is bringing welcome diversity to the global financial system, but it's also, in some cases, increasing the risks of sudden stops in capital flow reversals. It's important to remember, and again at the IIF, I'm telling you something you know and live every day, that market-based finance has accounted for all of the increase in foreign lending since the crisis to emerging economies, as bank lending has declined and FDI has stayed fairly constant. Investment flows to emerging economies now account for around 1/3 of total portfolio flows compared to 1/10 prior to the crisis. And these flows can be volatile, reflecting in part their promise of daily liquidity to investors despite investing in potentially illiquid underlying assets, such as emerging debt. Such structural mismatches mean that these funds can behave particularly pro-cyclically. Our work at the bank finds that emerging bond funds, redemptions in emerging bond funds in response to price falls are 5 times those for emerging equity funds, and in turn, emerging equity funds, their response to redemptions are twice those of advanced economy funds. Well, the shift to market-based finance has increased global capital flows. That's the positive diversification. It's also amplified the spikes in capital flows at risk. And that's particularly the case when there is a push shock. So the second factor, the asymmetry in the global international monetary and financial system, when you get a shock out of that, that is amplified by the changing structure. Now, those were two elements of the pipes. Let me just mention the third, which is the global financial safety net itself. This has become more fragmented over the course of the last couple of decades, and its core IMF resources has shrunk relative to the size of the global financial system. The consequence of that and other factors has been that many emerging economies have chosen to self-insure. And that has been effective. The extra reserves accumulated over the past 2 decades have reduced the sensitivity in our calculations of capital flows at risk to those push factors, the shocks from the center, by almost 50%. Now that comes at a cost. It comes at a cost of financing and crowding out domestic investment. And it also comes at a global cost in terms of externalities, with this vast accumulation distorting yields, building global imbalances, and, as I said at the start, because of its effect on the global neutral interest rate, increasing the risks of a global liquidity trap. Putting these factors together, these pipe factors together, we estimate that the growing shares of FX-denominated debt and the growing increase of market-based finance have increased the sensitivity of capital flows at risk to push factors by 50% since the crisis. So effectively using up the benefit of this self-insurance. And further, and this is somewhat speculative, but it's consistent with financial development elsewhere, these vulnerabilities are likely to grow. If history serves as a guide to the evolution of emerging economy balance sheets, their external liabilities could double as a share of GDP by 2030, and in that case, market-based finance could account for half of external liabilities, with investment funds representing about 40% of financing flows. So you bring all that together, the sensitivities of capital flows at risk to push factors in that world could triple. So it's plausible that the dollar will be as dominant in 2030 as it is today. There's real network effects and self-reinforcing effects that keeps it in a position, but the structure of the system continues to move in a direction that amplifies potential shocks from the center, and in such a way that actually it doesn't just cancel out the self-insurance that had been done to date, but cancel out the net benefit of the financial reforms that have happened in emerging economies over the course of the last 2 decades. When I say cancel out with respect to reducing the volatility of capital flows to them. Obviously, you have to take calculations like this with a grain of salt, but what they do suggest is that in a world that combines the growing importance of market-based finance, that has this deep asymmetry at the heart of the international monetary and financial system, that fast reforming emerging economies could be running to stand still in their quest for greater sustainable finance. So let me turn to a few of the policy priorities that come from this, and then I'll conclude. Okay, the first set I'm going to say is going to sound a lot like keeping your house in order, because that's a good idea in good times and in bad. And that means continuing a continued determined reform of domestic institutional frameworks so that pull factors are insulators rather than amplifiers, reinforcing the progress on monetary credibility, safeguarding central bank independence where it's there, putting it in place where it's not, using fiscal space carefully, given ongoing structural imperatives, the rising risk of global shocks, and the clear limits of monetary policy, reinforcing banking resilience, deepening domestic capital markets, and particularly continuing to develop the macroprudential toolkit to guard against excessive credit growth and high levels of indebtedness. And in this regard, I just mentioned that as part of the work we've done, we find that tightening of prudential policy in emerging economies reduces the spillovers from a U.S. monetary policy tightening by around a quarter. So there's a reduction of this. So this is something that we are finding is significant across emerging economies as a whole. But obviously, in terms of policy imperatives, it's not just about keeping one's own house in order. The neighborhood has to change as well. And I will say, and be clear, it's unrealistic to expect that advanced economy policymakers will fully internalize the spillovers of their policies on emerging economies, given their domestic mandates. But they will need to increasingly take into account those spillovers and the spillbacks to their own economies. The spillover to the rest of the world from a tightening in U.S. financial conditions is now twice its average in the 1990s. And taken together, the spillover and the spillbacks have increased because the world's more integrated and the emerging economies are more important. If you take those two together, the effects of a tightening in U.S. policy, those effects have tripled since that period. So this matters a lot more, and the Fed is and has to continue to take this into account, and we would expect that effect to continue to grow as financial integration continues. It also means that the responsibilities, this situation also means the responsibilities of advanced economy authorities for their own financial systems, particularly in the global financial centers, are particularly important. After all, these are not just domestic financial centers, they are global public goods. Certainly at the Bank of England, the city, we take these responsibilities very much to heart. And that has explained the degree of reform that we have undertaken and the ongoing commitment to it. The other point, though, in terms of advanced economies, is to recognize that this growth of market-based finance and these investment funds, well, 2/3 of these funds are managed in the U.S. and Europe. And so these are the funds providing, in many cases, not just the marginal, but the core of growth finance to emerging economies, and raising some of these issues. So there is a macro-prudential responsibility, again, not just domestically, but globally, for the authorities who oversee that. This is, particularly relevant. It's part of the reason why we're doing stress testing of these funds in the system at the Bank of England. But it includes the current IOSCO consultations on metrics for measuring synthetic leverage at these funds, and also the FSB's and IOSCO's evaluation of measures to address mismatches, liquidity mismatches in funds. And these will be crucial to our better understanding of these dynamics. This is an area where I make an appeal to this audience, this organization, very much welcome the IIF's perspective on these issues. I mean, again, if I go back to 36 years ago, the start, even if I go back to 10 years ago in the crisis, the increased diversity and geographic breadth of this organization is truly remarkable. It reflects the shift in the global financial system, and it really can provide a unique perspective on these crucial issues. Just quickly before concluding, I should mention that obviously, global with Jose Vinales here, in his former role, the importance of the global financial safety net and getting this right. It is something that is on the G20 agenda. We're in a world where countries are self-insuring, and to maintain their reserve adequacy, given some of the projections you've just seen, emerging economies would need to double their level of reserves over the course of the next 10 years, $9 trillion US dollars for purposes, or you could get the same self-insurance for $3 trillion of IMF resources, in keeping the IMF at the same share as there. That's where the discussion should start, particularly given the externalities and feedbacks and the shared responsibility for the reason for this self-insurance. Okay, I promise to conclude, and I will. So in a deceptively simpler time in the pre-crisis world order, keeping your house in order was a handy prescription to emerging economies. And when countries were hit by volatile capital flows, they were admonished that there were, and I quote, no innocent bystanders, and that by doubling down on the Washington Consensus reforms, they could be free to enjoy the benefits of sustainable cross-border investment. I think the experience of successive crises and shocks, that would seem to be confirmed by the analysis I've shown you, suggests that that advice, that keep your house in order advice, was worthy but incomplete, and increasingly it's incomplete. The significant improvements in institutional frameworks of emerging economies are being offset by a deepening fundamental asymmetry in the international monetary and financial system, the continued shrinking in the size of the global financial safety net, and the rapid rise of market-based finance. Now, there can be innocent bystanders, but there should be no disinterested observers. We're all responsible to address the fault lines in this system and its safety net. And as I just said, the IIF, with its diverse and global membership, can make an important contribution to this. And of course, the reason we're doing this is that by reducing the volatility of capital flows, will increase the sustainability of cross-border investment, and through that, be able to meet the great challenges of our age. Thank you very much for your attention, and I think Axel can ask you some questions.
Thank you, Mark, for doing this, and I promise we'll just be another 10 minutes because, as you indicated, we'll have the reception. Fascinating insights. Again, I don't want to repeat, but maybe I want to start off with a question. Absolutely, I think we've seen that the core responsibility of emerging markets is still there, but it's not sufficient. The second point you mentioned is the core responsibility the US has as a renumerator of the system. If that is exercised well, I think the system is pretty stable, but we're seeing that the US system and a dollar-based system hasn't really changed. What is it we can do about making the third element, the pipes as you called it, the international funds, more sort of work along the lines that it actually helps emerging markets? Because they're not regulated in the same sense the core of the banking system is. Do you see there a regulatory agenda, or is it more an agenda where you want to increase stability in other ways?
Well, as usual, you get right to the heart of the issue, and I think, as with many things, it starts with recognizing that there's a problem or there's an issue, and I don't want to. And the reason I switch from problem to issue is that there is a tremendous amount of good in the growth of asset management, cross-border market-based finance, absolutely, but interacting, as you just said, with the structure of the international monetary and financial system, which will probably persist for some time, it has this potential in tough times to really amplify capital outflows. So recognizing that that's a problem and getting a sense of the dimension of the problem is part of the issue, and the fund is working on this, and colleagues around the table, and having that proper debate and the private sector feeding into this and a better understanding of how the system works. That's the first thing. The second thing is that in the world of surveillance and policy, not necessarily coordination, but cooperation or understanding, it's recognizing that if there is a big shock, what could the dimensions of the outflows be, and what steps could the emerging economies take reasonably to help dampen those adjustments. Because one of the big issues, as you know from being around these tables, is intent. The extreme versions of this are capital flow management and other policies, which very quickly can become addictive, can be highly distortionary, and very easily can lead to retaliation. But there are some circumstances where they may make sense, and this is something that the IMF is trying to think through, individual countries are contributing to, and that should be part of it. But then you get to the third point, which I think was the heart of your question, which is well, what about the funds themselves? And I think, our view is that we need to be quite deliberate and disciplined in thinking through the maturity structure and liquidity structure of these funds, and what is liquid today can be very illiquid tomorrow. I'll give you two quick examples. You know this, but first in the UK, immediately following the referendum, REITs, which were daily liquidity funds, closed REITs, became very illiquid. Not surprisingly, ultimately they had to put up gates and do other liquidity management. That was, you could have anticipated that, I would have said. There's been a very high-profile individual fund issue just in the last week or so in the UK, which is another example of that. Much of emerging market sort of corporate debt has these types of characteristics. Some of the more aggressive high-yield funds have those characteristics as well. So thinking through what's the right liquidity, and this is liquidity management for that. This is partly a coordination problem, and so but it needs to be thought of not just within one country's thinking, because the cross-border spillovers are quite large.
One of the agendas that we talked about 15 years ago, Mexico had the first G20 presidency, Germany had the second. The topic that was on top of the list was developing local currency bond markets. We're probably further from that than we were at the time when we hoped the next 15 years could lead to that. Should we take that agenda up? How do we get to a more multilateral, multipolar system? Because you just showed the numbers for the dollar. I don't think they've changed entirely over the last 15 years. So what is the alternative to the agenda that we had then? Is that off the agenda, or will it come back up on the agenda?
Well, I think it comes around. It does make you feel. It was Morelia, wasn't it? Was the Mexican meeting which we had that, because that was the first one I went to. And now some emerging economies, I hesitate, Mexico in this regard, but really did follow through on that agenda, building out benchmarks, and the domestic institutional investor base, as you know, is a key component of that, which it takes time, it takes pension reforms, it takes life cos, it takes private savings accounts, other things to build that up and build that capital. It also requires recognizing that, in the end, there should be flows from advanced to emerging. We've been in this odd situation where the bulk of flows have been going uphill, and partly because of some of these deficiencies. The short answer is, I think the core of that agenda is right. It's been implemented better in some circumstances than others. Even if it's very well implemented, we're in a world where the scale of cross-border flows probably needs to materially increase, and will do so if it can do relatively safely. But if you were parachuted in to be the central banker in an emerging economy, I think you would want to have a sense, as you saw the money flowing in, what's at risk of it flowing out, and what are the circumstances in which it could flow out, what's the structure of the borrowing, what's the nature, what's our spillover from the US, et cetera, for this given economy. And that's part of what we need to develop better.
I mean, your analysis on capital flows at risk ties very closely to the IMF analysis, which also identified the dollar or the strengths of the dollar period and level of long-term US interest rates as key determinants as risk appetite is in these markets. Probably the elephant in the room when we talk about countries opening up for international capital flows is China. What we're seeing, with the inclusion in bond indices or in the equity indices, China will see 200 to 300 billion inflows just to match balanced portfolios. But that's not a full reflection of China's weight in the global economy, so it could go much further. But at the same time, the experience you alluded to will make China's opening up process very cautious to the risk of outflows because it could destabilize their economy. So in terms of these other issues like the new role of special drawing rights as an international reserve currency, the emergence of the renminbi, the fact that China increasingly wants to look at renminbi invoicing for their hemisphere, are those all measures that could lead to some uncoupling from these risks?
Yeah, I mean, it's a whole a huge set of issues, and everything you say is important. I mean, there will be a rebalancing at some point of global reserve currencies. It tends to happen, experience in the UK, it happens later than the rebalancing of global economic weight. A variety of other factors will influence them. One of the prerequisites, of course, is an opening up of China, for China to play a greater role. And exactly as you were saying, the building blocks of that, whether it's invoicing for bilateral trade, flows through Belt and Road, being part of that. We think that part of the internationalization of the renminbi will be driven by the development of the green bond market, the local currency, the renminbi green bond market, because that's linked into the development of the municipal finance market and the reforms there. So all of that will build up. One of the interesting things will be what happens. We don't have time to get into it, so come back to the next IIF meeting, we'll talk about it, but what will happen on the payment side. I mean, your previous discussions on fintech and thinking about that, but what will happen both in the gradual internationalization of what is quite a sophisticated payments architecture has been built up in China, what will happen to Western payments G7, if you will, payments architecture. Will those be linked, and will that be one way that this moves a little more seamlessly? I think those are legitimate open questions, which can feed into arguably a more sustainable system if handled properly.
Right. I want to stick for a minute, and we can go slightly over, on your green financing issue you just mentioned. In particular, there is where we don't see such a dominance of the US. Actually, that is an issue. The PRA just gave some guidance where Europe, and potentially also this region, China, will be investing and will be driving financial markets that have a decisively more green flavor. Where do you see these markets developing? Could that market development alleviate some of these concentration risks that we have? Because many of the funds you talked about, you said friendly US and European funds. It's largely US funds if you look deeper down. Could that elevate some of the problems?
Yeah, well, it's yes is the short answer, and I think you are right in that the more cutting-edge developments are in Europe and in Asia, and we should acknowledge what's happened in Japan over the course of last year with significant take-up of the TCFD on the corporate side, but also the financial side, which is going to help shape. I think that what comes out of that will be a much better and more useful product for investors, for banks, ultimate providers of capital. But look, it is a more sophisticated conversation in Europe, and I dare say here, about climate risk transition risks, and it's a more, and also, and again, thinking of your day job and your wealth management arm, in terms of the return characteristics, which are not social license or nice to have or ESG type, but actual alpha that's starting to be driven by companies that are anticipating where things are headed. So I'm sure the U.S. will catch up, and some of the big players are quite sophisticated, but at least from where we sit, what we see is more of the innovation is in Europe and in Asia now.
Well, that's an optimistic note, so we should end on that. Ladies and gentlemen, let's give a round of applause to Mark Carney.